people focus on the mortgage side too much on the costs. I'll be honest with you, I think a lot of people just assume that they can't do something.
Anthony Emmerson is director of mortgage broker Trinity Financial.
But with interest rates starting to incrementally go down, I'm not going to pull the trigger on an application immediately. And that's the one thing a lot of people forget.
Let's start then with, what do you think the most common mistakes people are making when they're a first-time buyer approaching buying a home?
I think the main thing with that is that people aren't preparing early enough. They're quite happy to jump on Rightmove and all these other things and go and look for a house, find the house that they want, and think that's the important bit. They forget about doing the finance side. And actually, if you prepare yourself and get all the finance sorted, you know what paperwork, what documents, what costs, what, all your stamp duties are going to be and all the other bits and pieces, you're a hell of a lot more organized and you'll be more prepared to know exactly where your ceilings are, rather than go and spend all that time looking for a house, only to come back and find out that you can't afford the loan size you thought you could get. The deposit hasn't been structured in the right way and the lenders will or won't accept it. There's a lot of things that would trip you up. And I think speaking to a broker early, getting out there, and I say speaking to a broker, I mean, we're doing 85, 90% of all the mortgages out there at the moment are done through the mortgage intermediary route. And the reason behind that is that we have all of the different lenders that we can speak to, and we know all of their different criteria. And you come to us with a certain problem, we'll probably have an angle that we can approach it from that'll solve that problem and get you the loan size that you want.
So as a first step, get a mortgage broker or talk to a mortgage broker?
I would definitely say that would be, if I was doing it, that would definitely be the way I would, because it's pointless going and spending all that time. And it's an emotional investment when you're looking for a residential home, right? Especially if you've got kids and what have you. You need the schools and you need this area and you need, this timing and things like that. Get yourself sorted so that when you find the house, you can get the money. You know exactly what paperwork is going to be required. You know roughly which solicitors you want to use. You know what your costs are and your stamp duties and all the other bits and pieces. Your deposits all structured in the right way. When you hit the button and you say, right, I want that property, everything else is known to you and you can just apply for it. The only thing that might change in today's market is obviously the interest rate that might be applicable. Thankfully, we're going down rather than up. And I think the other thing is that people focus on the mortgage side too much on the costs. If you come into a property and you say, right, actually, I want to buy this house would have a different financing requirement to possibly a house down the road that's maybe 50 grand more expensive, but's had some of the works done. I might be able to keep back some of your deposit. I might be able to open up some of your available cash so that you can do the works, but you need to know what those options are.
How do lenders decide on lending criteria?
As a borrower, the things that you need to consider are your credit score, your sort of debt levels, so all your credit card debts, your student loans, your car loans, and all the other bits and pieces. You need to have a firm grip on all of those and how much each one of them is, what the outstanding balances are, how long the terms are that each of them are running on. We need you to understand exactly what your salary, your bonus figures are, so that we know exactly what the cash element of your bonus is, rather than anything sort of stocks and shares related. If you are self-employed, we need you to be able to provide us with, get in touch with your accountant, get your last 2 years income calculations and tax year overviews. You then also want to ask for your last 2 years signed accounts from your accountant. And that will then allow the lender to see that your business is solvent. And if your business isn't solvent, then you need to be able to have that conversation with your broker to understand, which angle you can come at for obtaining the loan that you want to obtain. But your credit score is important because of the fact that so many times we get people come to us, they didn't know that they had a default for a gym contract or a mobile phone contract in particular from, 5-6 years ago. It's just been sent to previous addresses. No one's got in touch with them. And, this will impact your credit. You can go online and you can go to ClearScore and you can get your credit report for free. You can go to, Check My File, which will give you a free 30-day trial on your credit profile. Lenders will also look at different risk strategies. So we'll get some lenders that are more willing to go to the higher loan to values than others. And I think that's where you going down to your bank and sort of asking them the question direct loses a hell of a lot of that, because you're only going to get what your bank can offer you.
And what's the difference for self-employed people?
Self-employed people are probably the group that needs to do their homework as early as possible. And being a self-employed person, if you are as aggressive as you can be in offsetting every single cost that you can ever do, you can actually make yourself look like you're earning a hell of a lot less money, all right? So that you're therefore paying less tax. But then if you come to the borrowing side of things, you can only afford what you can show, all right? So it's a bit of a double-edged sword, and that's kind of where we got to look at people having this conversation as early as possible so they can understand, especially if you're coming up to a point where you're about to do your new tax return, right? Because you might not want to be as aggressive as you can be, to be able to show that you can earn a little bit more money and you're a little bit more profitable, and you might be able to borrow that extra 10, 20, 15,000, 10, 20, 30,000 pounds more because you've elected not to offset everything that you can. But invariably what happens is you're not earning enough for what you want to do from the lender's eyes. But we have different ways of looking at it as well. So we can look at it from a lender that goes, we'll look at just salary and dividends and nothing else. And then we've got lenders that will look at it from a net profit point of view, where they will allow you to use the money that you haven't drawn out of the company towards affordability because you could have drawn it, you just elected not to. And as much as that sounds like of course, kind of common sense, there's only a small handful of lenders that will actually consider it on that basis. We have got lenders that will use your most recent year over your previous year, as long as it's in an upwardly direction. And if you're about to do your most recent set of accounts, you can lower some of your expenditure to make your most recent year look that little bit better. It's all got to be based on fact. You can't, make this stuff up, but you can elect as a business owner to not put all those expenses in. I think now is the time where people are about to file their latest sort of tax return, and they can be a little bit more favorable to themselves from a borrowing perspective, but maybe not so much from a income tax, point of view.
When I used to sell off-plan properties in Manchester, we'd have all sorts of weird rules around lenders where they'd be like, is it over 4 floors with a flat roof? We won't lend on it, things like that. And I don't think people consider that. They just think, I can borrow 300 grand. That's all that matters.
Yeah.
And
is it over commercial? That's a big stopper. Is it opposite a very busy pub? That'll stop it in its tracks.
I think the cladding one was a big example that a lot of people saw. They basically rendered all these houses flats to be worth 0 until the cladding was fixed, right?
It's still the same.
Yeah, they're still trying to get through the backlog.
And we've got solicitors now who say if a property is over 5 floors, they can't do the legal work on it because the government's brought in all these different requirements for fire safety and all the other bits and pieces, and they don't have the capacity to do it or the desire maybe to do it. And some people and a lot of solicitors have just said, no, we don't do that kind of business at all. So again, it comes down to that whole thing where you have a couple of solicitors that you might be able to work with, because you don't know if you're going to fall in love with a high-rise block or you're going to fall in love with a sort of Victorian conversion and made it split into 2 flats. Very different. Some legal work will be different. The works required on it, the service charge and the ground rent is all different. All of those things affect everything about the finance.
How long does it take to get up to speed before people should start going and looking at properties?
If you are able to provide us with, your details, your pay slips, your bonuses and what have you, a day or 2.
When you say details, it's just your financial life, pretty much.
Where you live, where you work, how long you've worked there, what the basis of your bonus is.
Easy stuff that you can just get. Nothing too tricky.
And I'll come back to bonuses, right? I mean, one of the things is that we've got certain people in the city who are paid on cash bonus, but they're not also given stock options. Most of the lenders won't touch the stock options. But if you look at the guy's P60, it's this phenomenally big number. But if I can't use half of that, then the agreement in principle that I've obtained off the back of that P60 might be incorrect. So I think speaking to someone and providing the paperwork and going with it, most mortgage brokers do the same job, okay? And I think it's very, very important to know that we have the same sort of sourcing software. This whole thing where certain mortgage brokers get, deals that are vastly better than somebody else might be able to get. It's a bit of a urban myth. But I think get someone that someone that you sort of get the right feeling from, because that person is going to be in control of one of the biggest financial decisions of your life.
What would be the difference then between someone charging a fee and not if they're all getting the similar kind of deals?
I think that comes down to a case company by company. Some mortgage brokers charge a fee because they feel that it's they're worth it, and that's their company policy. We've got other brokers who don't charge a fee at all. But again, you speak to a couple of them, get a feel for who's giving you the right advice, and make your own decision. You can buy a car that'll get you from A to B, but you can buy a very expensive car or a very basic car. Why pay more for something that'll do the same job? Mortgage brokers are much the same. And I think people who are charging percentage-based fees, I'd definitely stay away from. It's just too much money for what it is.
As far as an answer, if they're not charging a fee, how do they make money if they're not?
So the banks pay a mortgage broker what we call a procuration fee. So they pay us a flat amount, generally sort of around about 0.35 or 0.4% of the loan amount that you take.
And a mortgage advisor always gets that. So even one charging the client a fee will be getting
Correct.
that in the back end.
Correct.
So there's two bites of the cherry in a sense, or at least getting paid by both sides.
Yeah, but then it's a commercial choice by that particular broker, right? And I mean, I don't want to say one's right and what's wrong. Yeah. Sometimes it's worth it, sometimes it's not. I personally do most of my mortgages with no fee because of the fact that, I want to have a client for the long term. I get paid enough by the lender. But then, the other thing is I work in London. So my mortgage size is bigger. My average loan size pays me enough money to be able to make that sort of decision. If I was based up north and my more average property price is, 150,000 pounds, then you're kind of looking at making 50, 60,000 pound mortgages. You're going to get paid a couple £100. You can't survive on that.
Your heart must have dropped when I contacted you because I was like, I'm going to buy a load of properties.
I saw the ones you sent me, and I was like, oh,
yeah, they're northern properties.
Yeah. And I've got lots to put in. I'm like, okay, great, great. But like it's one of those things where you got to make that judgment call. Where I'd rather have a couple £100 in my pocket than in somebody else's.
The biggest change in the finance space in the last couple of years has probably been interest rates. We're now in this new era, having been at historically low rates for over a decade. The downside is we've seen mortgage rates increase, but the upside is we've seen savings rates increase as well. The funny thing is though, a lot of people, particularly business owners, have been slow to jump on this increase in rates. Are you getting a good interest rate on the cash that's sat in your business bank account? I wasn't until recently. This is why I'm happy that we're partnering with Tide. They offer an instant access saver account where new customers can get 4.07% AER variable on unlimited deposits until at least the 31st of March 2025. If you're interested in putting the money in your business account to work, head to tide.co/savings. There's a link in the description for you. For the full offer T's and C's and Tide's terms, visit tide.co/terms. Variable rates are correct as of the 7th of November 2024.
In terms of deposit requirements then, have they changed recently, or do you find that people still need like the same 10% as a first-time buyer, 25% as a buy-to-let?
So there's one lender who's kind of pushed the envelope out a little bit, and they are now doing what they call the £5,000 deposit. Now, it's the minimum size, so you have to do £5,000. The maximum purchase price is £500,000, so it does cover the vast majority of the UK.
So that's 99% on.
But it's a 99% mortgage at that level, all right? And that's how they marketed it. Do we do a lot of them? No, not really. Purely because of the fact that when you look at getting to 90% and the rates change and people think that's a little bit more worthwhile. Banker mom and dad still got a lot of money to be able to distribute down, especially now with all these inheritance tax changes. You're probably going to find a little bit more of that. But if you've got two young individuals buying the right property, and when I say the right property, you're about to put down 1% on a property, your chances of going into negative equity if that property changes direction and value is like as quick as you like. All right. So there are certain risks that come with it, but there's a lot of people who don't have deposits. They can't save it up quick enough because house prices keep moving. So it does allow you to get on the ladder, hopefully ride the wave up, and then, refinance in 5 years' time, because it is a 5-year fixed rate product with early repayment charges for those 5 years. So it's something that you get into, and it's a 5-year journey before you can renegotiate.
Early repayment charges, if you pay more, you get charged?
Yeah, so most lenders will allow a 10% of your outstanding mortgage balance per year. So if you've got a £300,000 mortgage, each lender would generally allow you to overpay by £30,000 in year one and 10% or whatever the balance is in year two, without an early repayment charge being implied. If you paid back more than that, you might have to pay 3, 4, 5%, whatever, depending on what the lender's criteria is, on the amount over and above the 10%.
Yeah.
So they do give you the ability to overpay. I'd probably say to you that from what I've been doing this 20 years, the amount of people that I speak to where, I have to have this 10% overpayment facility, that's where I'm going to do it. I talk to them 2, 3, 5 years, they haven't made any. They've done improvements to the house and they've done this and they've lived their lifestyle and what have you. They haven't made the contributions to the mortgage. And it's not always the right thing to do. When interest rates were low, you were better off saving into a ISA or other investment property plans because you got a better return than if you paid it into your mortgage. So, you need to look at your wider financial situation before you decide I'm going to pay off the mortgage quickly. But if I was in a 99% mortgage, I'd definitely look to try and make overpayments because that risk factor of negative equity is quite scary.
Yeah, they look at the deposit not as, just to get in the door, but the cushion that you have if the market turns.
Correct.
Yeah.
Especially if you're doing a high loan to value thing. So anything 90% plus, because there's 95% mortgages, which are, a little bit more common nowadays. That 99% mortgage that's available. It's one lender, but, at least it's available. Those things are great, but they come with an added risk factor.
Is the negative equity position only a bad thing if you can't pay the mortgage? And obviously you can't leave the house, right? You can't sell it.
It's paying the mortgage is fine because you've taken a mortgage contract and you signed up to that 2, 3, 5 years or whatever it is on that rate. You have to make your payments there, otherwise they repossess the house and you've got early repayment charges to pay, etc. as well. But the problem with the low deposit things is if the property market changes and goes in the opposite direction, when you come to the end of your 2, 3, 5 year product, refinancing and getting out of it into something else, you might find that the lenders are going, well, actually, no, we won't do those kinds of mortgages.
You need to give us 5K or 10K to bring it back.
Correct.
Yeah, okay.
So you might need to throw in a whole bunch of cash at that point to be able to bring it in. In today's market, we have a supply and demand issue, which given the way that, all of the previous governments and probably this one as well, they're not going to keep up with the amount that they're supposed to be building. So we are going to have more, demand than we have supply. So my gut feeling is that property prices will continue to edge upwards, which will be a good thing for those kinds of clients. But there's always the risk. We sit in a very weird geopolitical situation at the moment. If that changes, that'll have an impact on the wider market and things like that.
And interest rates are higher, even at low, even coming down to 3%, it's still 3% higher than it was. And that has a big difference. And people are still on fixed rates and they've got to come off them. I think, it takes a long time for the interest rates to feed into the full market, doesn't it?
I think there's going to be people on these nice low, cheap rates probably until around about sort of 2027, 2029. There's certain people that manage to get those last of those fixed rates at those low deals are probably going to be expiring in 2028. So some of those people are yet to feel the pain. And they are, the conversation that we're having with people coming off those deals is that they're finding it a little bit tricky to readjust their lifestyle, their finances, their commitments to fit in with this much higher cost.
Well, it's going to be hard for you to pull the figures out the thin air. So if you can't do it, don't worry. But moving from a 1% to say a 3-4%, what would that do on a home in terms of the monthly cost?
It depends on whether or not you're on a capital repayment mortgage or on a interest only mortgage.
Go on, mate. You can
What's the difference between a capital repayment mortgage and an interest-only mortgage?
A capital repayment mortgage means that every single month you are making a contribution towards the capital element of your mortgage. So you're servicing the interest and you're paying a small amount towards the capital. The way a mortgage works is, imagine you take a 30-year term. It works in an inverse curve, right? So you've got your kind of thing where you pay off a little bit and often in the last 10 years of your mortgage, you pay back the vast majority of it. The reason that it's not a straight line is because these initial payments would be super high. So they do it where you pay off a little bit and often, but it adds up over the course of 25, 30 years. And by the end of your 30-year term, you'll own the house. Interest only is exactly that. You effectively renting it. You're only servicing the interest. You're not making any sort of payment towards capital gains towards the capital elements of your mortgage. So your debt will never go down. So if you borrowed 150 grand, at the end of your 30 years, it'll still be 150 grand.
What's the benefit of that?
Well, like what Rob was talking about before, that inflation will have done a number on that debt. So if in 30 years' time the debt balance is still 100k, 100k has been inflated down in value. So, for example, 100k in the last 12, like say over the highest point of inflation, lost 10% in real terms. So buy-to-let investors tend to do the interest-only route so that they can extract out cash flow and so that they can let inflation. The argument is to deflate the value, real terms value of the debt. But obviously it's a risky position because you're never actually clearing the debt. And one day they come round and go, where's the 100 grand? Or where's the,
On your main residence, it's a risk.
Yeah.
Whereas on investment properties, you get to the age of 70, 80 or whatever it is on these terms, you kind of go, I'll just sell it all, realize the money and live off those proceeds. And you're right, the inflation and the capital appreciation of that asset gets to a point where if you bought the house at 300 over the course of 30 years, it's going to be worth 6, 7, 800,000 at the end. You then sell it, you pay off the 150 and you can then downsize.
Yep.
So on the residential side, a lot of the people who are using interest only have got, 4 or 5 bedroom houses.
Are they desperate? Is they're just trying to get the payment down? Is that?
Yeah, because we've got people, with kids in nursery. I mean, nursery is ridiculously expensive.
You're telling me my son hasn't started yet because it's so expensive.
And
Give him homeschooling, home nursery.
You're telling me I have absolutely no idea because I don't pay it. That was your take.
I've seen the prices. I refuse to pay them because I've seen the prices. It scared me off.
It negates an average person's entire salary. Like it just, and that's a
kids,
a decent earner. We're talking in London in particular. We calculated out you got to earn about something between 55 and 70,000 pounds a year to net out enough to cover your nursery costs for a kid. And it's bloody ridiculous the cost. But
up north, we just put them to work, send them down the coal mine,
Get him in the mine.
Get down the mine.
But the reason that some people are doing the interest only is because they've got these extra costs that maybe, and that people don't want to do interest only for their whole mortgage, right? And that's the one thing a lot of people forget is that we have a conversation and you're 30 years old, you've got no dependents. You're going to put you on capital repayment because you start chipping away at it. You then come to the end of that and you say, hey, I'm about to have my first baby. Great. When we remortgage you, we can put you on interest only because 2 years after or 1 year after you've had your first baby, you're more than likely going to have your partner going back to work and then nursery is going to start. At that point, we can free up a little bit more cash for you to be able to pay for those costs. And we might put you on a 5-year interest only mortgage to get you through that nursery. But once the kid's off to school,
Go back.
you can go back and you can carry on paying it. And because you've got that 10% facility, you can use any surplus cash and bonus that you might get or anything like that to knock lumps off. But it's your choice.
So this is why it's so important to have a good relationship with your mortgage broker because they're going to be with you for the long term and you'll tell them all aspects of your life and what's changing and things.
Yeah, and you know what? You can call up someone and just say, hey, I'm thinking about leaving my job. I've got a remortgage in a year's time. What are the impacts of me going self-employed today? In which case a mortgage broker's going to go, whoa, understand these points and then make your decision based on that. So it is important to have that. And you can't also have these conversations with your bank. So that's why more people are using mortgage brokers than they are using their bank. Because imagine you walk into your bank going, hey, I'm thinking about going self-employed. The guy's going to run a mile and the lender's going to start watching your case like a hawk because they're going to be worried about, you missing payments and all the other bits and pieces. Maybe unnecessarily, but it's a major flag for them. And
why is that? Because why does it seem that self-employed people, it's harder for them to get on a property?
Because especially starting a business, most self-employed people don't survive. If you look at the fail rate of businesses, the first 2 to 5 years, the fail rate of businesses is quite significant, which is why lenders sort of say, if you're self-employed, I want to have 2 to 3 years worth of accounts so that I can see that you are on a stable footing.
You mentioned around fixed rates there, and I think something that people might not think about is they can use them at different times to suit their lives. But like, for example, the nursery example, but we lock in for periods of time, don't we? And we're kind of stuck in the mortgage there or thereabouts through that period. How should people think about how long they should secure a mortgage for?
It's your attitude to risk and your perception of what's to come, right? Because
you got to guess some interest rates.
yeah, and I mean, you polish your crystal ball and you place your bet and you hope for the best. But it sounds rather dramatic, but it's not that bad. But ultimately, you will be offered choices, all right? You can go for a 2, a 3, a 5-year, even a 10-year fixed rate. There's only one lender doing 30, 35-year sort of fixed rates, but they're not overly attractive.
Not right now.
There's one now.
I mean, not attractive right now. They were a couple of years ago.
They're at 6 point something %. So, it's ridiculously expensive. But I think you've got to look at it and kind of go, right, I bought a house. What am I going to do with that house, right? If I'm buying a house and I've got money and I'm going to do a full, loft conversion, rear extension, I'm going to take that house from being 400,000 to 500, 600,000 pounds. Do I want to be locked in for 5 years? Yeah, maybe not, because I'm going to increase its value. I can then remortgage that property, maybe pull money out, go and do other investments with it. Maybe I remortgage it and go into a lower loan to value, therefore a lower interest rate in 2 years' time because of that uplift in value. That conversation is, going to be more directed towards shorter term interest rates, because as long as the belief is that interest rates are going to be going down, which at the moment they are, those people will be able to get in, get the work done, realize the increased value, lower loan to value, cheaper mortgage rate, out the door with something cheaper, all right? The flip side is that you have a conversation with someone who's going, right, and I've got a job at the moment, I want to do this, buy this house, I'm about to have a kid, or I'm about to go self-employed and start a business. We will then have that conversation saying, right, with all these risk factors, maybe going for a 5-year fixed rate to give you time to have the child, sort your finances out, give yourself the 5-year period for your income to be able to appreciate and increase through promotions and, salary increases and things like that. Or if you're going self-employed, you might have, your first 2 years might be quite difficult, but then you've got 3 subsequent years to get your accounts bang on so that when you come to remortgage, you've got all your options. There's fixed rates and then there's tracker rates and variable rates and all the other bits and pieces. And the tracker rates tend to have no early repayment charges associated with them because they're flexible products, but they're not for everybody, because generally they're more expensive than fixed rates by quite some significant margin. And although interest rates are headed downwards, it's about how quickly they go down. Are we expected to see them cut 1% off the interest rates in the next 6 months? Probably not. So therefore, going for a tracker rate, you might not be better off. If, they end up cutting fixed rates, you might look back and kind of go, it might have been better for me. But if it's 1% cheaper to do a fixed rate today than a tracker variable rate, you might say, well, actually, over a 2-year period, I'll win for the first year, but then I'll lose maybe for the second year, and the average of those two will net out the same.
How much do you think people should worry about all of this? Because I think it's the kind of stuff that can put people off buying. They just sit there going, oh, rates are going to come down, I'll wait. And
well, I think people should always investigate fully what their options are and understand what they're signing up to. Because if you don't, the chances of you making a mistake are far higher.
Is there a time when it's too early to reach out? So if I'm thinking about buying a property in 2 years, is now the time to talk to you, or like a year before, or when we have everything in order and you're ready to, I can buy like in the next 6 months or something? When should people first?
I think when you decide that you want to buy is when you need to sort of start talking to a mortgage broker. If you think, I'm going to buy in 2 years' time, it's too early, because, you look at the landscape and how it's changed. 4 years from now, 2 years ago, and even now, and in 2 years' time, it's going to be unrecognizable to what it is today. So, going too early, the advice that you obtain at that point might not be very valid to what you end up with. When we had inflation at its sort of 10%, and we had the cost of living going out of control, all of the lenders were tightening their affordability. But now that we're headed in the opposite direction, they're releasing it again. So a guy who was only able to borrow 200 before might be able to get 215 now, right? And that makes a big difference, right?
Yeah.
In certain parts of the world, that's another bedroom.
It's another house from the ones I was going to do.
And it's another street, so
Slum landlord in the north, David.
So there's always these changes that are happening, and at the moment, what we're seeing is that there's a hell of a delay probably longer than what we used to between, hey, I put my offer in and I'm going to complete. It's becoming longer and longer and longer because there's so little stock out there that to complete the chain of people all moving subsequently, because to start a chain off, you need someone who buys the property as your first time buyer. So he's your first link in the chain. And then to complete the chain, you need someone who's going, I'm selling that house. It's either an investment property where, I don't need to move to something else, probate to death, or somebody who just goes, I'm prepared to move out of that house and rent something myself. That's what starts and finishes those.
How big do those chains get?
Some of them can be like really big. I've seen them 15 sort of people. And to be honest, like that's where the estate agent makes their money, trying to keep all of these people moving along.
So it's all moving them all from house to house.
Everyone's got to move.
Everyone's got to shift along.
They all want to move on Friday the 13th, right? And there's a convoy of trucks that will come and move them from house to house.
That's the one you hit when you fell off your bike.
Yeah, I fell off my bike on Friday the 13th. Lime bike, it was not fun. So,
Those things are evil. They take off so quickly.
I was doing speeds.
What, do they pedal themselves?
No, they're electric. So
they're electric. So
you put your foot down, it's like...
as soon as you...
This guy's like, I'm doing my fitness and I'm alive. Like, he didn't tell me they're electric.
You got to pedal a little bit.
You've got to rotate your legs. That's the best you got to do.
Stop telling me this. Don't make it sound even worse.
To be a pianist with one of those self-playing pianos.
Probably why he didn't see that truck. It was like probably looking at his phone.
I actually was. I was literally going into my pocket to get my phone, other hand on the wheel, and then I hit a divot and just went over the handlebars. Hit like a bump, so yeah.
I always thought it'd be great to outsource all of the time-consuming admin in your personal life, from laundry to booking flights or whatever, things that just need doing. Of course, the same thing goes for running a business. And one of the most important bits of admin that you do as a business is compliance. I'm talking about stuff like showing you're compliant with GDPR, SOC 2 and ISO 27001, so you can just land more deals. Proving compliance with these standards isn't why you're building your business, but they are necessary to do so. So why not just outsource it? This is where our partner Vanta comes in. Vanta automates 90% of the security compliance work for you, getting you audit ready in weeks instead of months, saving you significant time and costs. As a special offer, Making Money listeners can get $1,000 off Vanta by going to vanta.com/makingmoney. There's also a link in the description for you.
So I made a video that was talking about, the decision between investing and overpaying a mortgage. And in there, I talked about fixed rates. And the video just so happened to catch in America. And they were just like, who the hell has a 2-year fix? Like, what is wrong with you people? Lock it in for 30 years. And they just couldn't wrap their head around that our mortgage market tends to be short-term products. You alluded to the fact that there are 30 years, but why is that the case?
I've been doing this 20 odd years and I've never really known lenders to offer anything more than like a 10-year fixed rate. The problem is that all of these rates come with some sort of early repayment charge. In America, my understanding, and I don't know their market, my understanding is that those 30-year mortgage products might come with a short window of early repayment charges, but they expire and then you're just on this fixed rate for the rest of the time and you can exit at any point. We don't have those products available here. The lenders haven't developed them because the clients haven't really had a desire for them.
They make more money out of the...
Our average first-time buyer stays in a house for 3.5 years, right? So, you think about, you sign up a first-time buyer into a 30-year deal, which has early repayment charges for 30-odd years. That person's going to have to either port that mortgage, which means you take the mortgage from property A to property B, and then maybe increase the borrowing on it or whatever it might be, or pay that mortgage off and take an entirely new one. Again, earlier we were talking about, whether or not you're going to do works to a property and improve it and things like that. The housing stock in the UK generally will allow you to do some sort of extension, some sort of rear loft conversion, make it bigger, make it improved. If you take a 30-year deal, you can't just go back to the lender in a year or 2 years when that property's done to kind of go, hey, I want you to realize my new valuation. I want you to give me a better deal. And I think it comes down to one of these things where you have to look at it and kind of go, what rate am I getting? Is it worth me changing to a new product with a new fee? And how much will I save overall compared to what I was on? And I think those 30-year products are too expensive. They aren't popular enough, so we've only got one lender doing it. So therefore, there's no competition. There's no, and the market's just not there for it here. And it hasn't ever been maybe because of the fact that most people in the UK are a little bit more transient in their properties. If we started off with, every lender offering a 30-year product with flexible terms and things like that, yes, absolutely, some people would have taken
Especially
those out.
at like 1% rates.
Absolutely, yeah.
Yeah.
Why wouldn't you, right?
Yeah.
And the US market was very fortunate in that. But, those lenders are going to be absolutely hating life. The fact that they've got to carry on their books a 1% mortgage for 30 years.
That's what I was
Our
thinking.
lenders don't have that problem.
Don't they lose a lot of money though if the rates change?
They
Like,
buy the money in. So, everyone thinks that money is derived from the Bank of England base rate. It isn't. The money is derived from a variety of different sources. So, I'm a bank and I've got a 5-year term deposit, all right? And I'm paying you 2.5% for your money to come into my bank for that. They can lend it at a margin above 2.5% in order to make money. You couple that with the Bank of England's rate where, that might be 4 or 5%. You then couple that in with the swap rates where all the various different banks are all trading the money at a slight margin. The swap rates have come right down, which is why we're seeing these sort of drops in the rates that are being offered to clients. The rates that we're getting now, we're doing 5-year fixed rates at 3.77, 3.8, 3.9. The Bank of England base rate is still 5, but we're doing rates at 3 because inflation's come down to 2.2, which means that we're paying savers on your sort of, current accounts or whatever, maybe 2.5, 3%, whatever it might be. Those lenders can lend a combination of that money and some of the more expensive money combined together and lend it out at a margin which is lower than the Bank of England base rate. The Bank of England base rate controls so much more in the market, but not primarily what the banks are lending the money at.
Is it? I think what happened was when the interest rates started shooting up, the mortgage rates shot up, and maybe that led people to think that they're linked. But it's more the shock of the increase that led them to ratchet them up, was my understanding. And if there's an expectation that rates are going to go down, it's probably
there was
already
uncertainty
priced
in the market.
Yeah.
And when there's uncertainty, you price it in. And rates shot up to 6.5% or whatever it might be, and then came back down. It's like petrol prices, right? It goes up in line with real time, but then comes down, in sort of incremental stages. I think too many people think the Bank of England controls the rates and the costs of money. It does to a degree, but not really the way that high street banks are using to price their mortgage products.
Okay. So there was a period, say, where Liz Truss, for example, and what happened there, and the mortgage rates went crazy for a little bit. And there would have been people that were just so unlucky at that point that they came off their fixed deals and maybe they locked in at the highest rates possible, at the peak rates, or maybe they waited it out. Is there kind of like a playbook of how people, when people come off a fixed rate deal, whether they think, should I wait or should I leave it? Or is it more of this kind of...
When you're 6 months out, contact your broker, start talking about what your new finance might be. We're having those conversations with clients, who are on our books. If you're my client now, I'd call you up 6 months before your fixed rate expires and say, right, what are your plans? What do you want to do? What are your incomes? Right, we can facilitate what you want to do, either remove or remortgage, stay where you are, all these things. But with interest rates starting to incrementally go down, I'm not going to pull the trigger on an application immediately because of the fact that if we wait until we're closer to the point, we might be able to get you a better deal. There is some merit in sort of saying, secure something now because you don't know what's going to change in the very near future. And like it's talking about geopolitical issues and what have you. If war kicks off in various parts of the world, it might have a knock-on effect to the way the finances are affected and things like that. So maybe having something locked in where you go, right, that's worst case scenario, and then talk to your broker over the course of the next 6 months to see whether or not things get better. And if things keep drifting downwards, we only need around about 6 weeks before your expiry date to switch you to a new lender. If you want to stay with your current lender, we can do it all the way up to the 20th or so of the month before your rate expires. And that's only because the bank needs to have time to set up your direct debit for the new rate when your next payment comes out.
Is it ever beneficial to come off the fixed rate onto the...
So I've got actually one of your listeners has got in touch with me, and we've run a whole scenario. They remortgaged at a point where, the Liz Truss budget and rates went up, their fixed rates expired. It's a timing thing. they had to remortgage. They had to take the product that was available. They took a 5-year fixed rate for some reason, maybe thinking things were going to get worse. But we've done a sort of cost analysis of all of that versus what we're on now, and we can get them a cheaper mortgage product that would make it worthwhile them paying the exit penalty and still save them money on what they're on at the moment. The rates are still continuing to drop, so they are just holding until we, hopefully get to a point where they go, right, it's enough money.
It's going to be a
now for
better
me
and
to
better
do it.
deal for them then
Yeah.
as well. So that if it makes sense now, if rates do drop like we anticipate,
Correct.
it will get better.
And that's the problem with that, is that, we've done all the analysis, we've worked out it's worth doing, but the right advice is actually, I don't want you to pull the trigger just yet because it's likely to get better. But if you're buying a house, you have to pull the trigger. But then if you've got 3 to 4 months between your offer being accepted and your mortgage going live or you drawing down on it, we have got the time to review those rates, and I might even change lender entirely. I've had cases where I've applied to NatWest for, the start of the mortgage. Halfway through, Barclays has come out with this amazing rate, and we've gone to Barclays and we've got another mortgage offer. A lot of mortgage brokers don't like doing that, but the right advice is to do it and get that in play. Keep the NatWest one live, keep the Barclays one live, and then run them both concurrently. And hopefully, if either one of those rates improve again, because when you're dealing with a top 6 lender, they're super competitive. They have to get a certain amount of money in through the door in order to keep their doors open. So they are always looking at where do I need, and they control their volume of money coming in by the rates and the position on the table that they take. So if you find that NatWest had a bit of a quiet August, you might find that in September they go, we need to do something on this because we need to get more market share. Otherwise, we'll be losing overall.
Do you find that loyalty to one lender is a bad choice then?
I think you should always review your options.
Is it like insurance? Car insurance, they just do you over, don't they? For loyalty works against you in the car insurance industry.
I think our regulators come down quite hard on them on that one. The FCA and the PRA have come down and sort of said, guys, you need to treat your customers a little bit more fairly. Don't get me wrong, we still got dual pricing, but what we see.
What does that mean? Sorry.
Dual pricing is when you've got one price for a purchaser and another one for an existing, or one price for a new customer and a different price,
bonuses and stuff,
and a different price which is slightly more expensive for an existing
customer.
client.
Yeah.
But is it worth looking at remortgaging? Always, because the other thing that changes is that you might be with, and I come back to Halifax, right? One of the bugbears that I've got with them as a lender is that they've only got fixed rate products and a tracker rate product, but everything's got an early repayment charge on it. So imagine you are getting to a point where you go, I have to remortgage in 2 years' time. I'm a first-time buyer. Average first-time buyer moves in sort of 3.5 years. I've had massive improvements in my income. I very well might move in the next year. I need to find a product that works for that client that they might be able to kind of go, actually, I want to be able to pay it off and go and take a totally new mortgage in a year's time when I move. Or I might be in the process of putting my house on the market. It's probably going to take 6 months to sell. I want to give that client a flexible mortgage so that we can nice and cleanly break that mortgage deal, move away, go and buy a new house with a new mortgage, totally free to go and choose whatever lender, whatever criteria I need. Whereas if you remortgage with that existing bank and they don't have those products, yes, you might get a decent product, but it might not be the right product for what you're looking to do. So again, speak to the broker, find out, and be honest. Like, talk about everything that you think could happen. Because if you don't tell the broker, he's not going to know. And the broker needs to know in order to be able to advise correctly and say, all right, we need to consider this, we need to consider that. Especially changes in employment, changes in expenditure, changes in your personal circumstances. How many times do we have, because of the cost of childcare, a partner has a second child and now we've got 2 kids under 4, and it ends up being, unaffordable for them to pay for childcare for 2 of them. And, that partner stops working. Most of these people only afforded that mortgage based on, the 2 incomes together. So there are options available for those people, and most of them are to remain with your existing lender, provided, of course, that they still deem it to be affordable.
I remember one of our friends, I won't say his name, but he was like, my mortgage has gone up by £2,000 a month. And he was like, we just haven't got it. Or we've got it. He's like, luckily enough, but it's basically fundamentally changed the way we live our life because it's just annihilated 3 holidays a year. You know, we've gone from being very comfortable to we now just live
Survival
to pay this
mode.
mortgage. Yeah. And it's a big house, you know.
And this is the thing is that, you know, we all look at maximizing the amount we can borrow and we go after, we chase the dream, but everything comes with an element of risk. And too many people don't really contemplate the risk factor enough. You know, if I look at on average, mortgage brokers are probably doing 4.5, 5 times income on the vast majority of mortgages that we do. And that is the very top end of what lenders are willing to lend. And it's only the older generation who are very much within their realm because they've had all these years of paying it down. But it's still quite scary for those people because if there's a change in circumstance, they'll find it very difficult very quickly. And that's why we only lend money to people who can 100% tick all the boxes on affordability. And why we only give 4.5, 5, maybe 5.5 times income, because of the fact that more than that, the lenders can't really sort of take that risk on too much of their book being on that higher multiple.
But the average house is 8 times earnings. In London, it's 12 to 14. In Chelsea, it's 34. So, you know, the average person needs to borrow 8 times their income to get the average home. So
Yes,
what do they
but
do?
then Bank of Mom and Dad steps in and covers the
Who's
difference.
mum and dad?
Yeah. People say this. I'm
Who's
like,
your
who
mum
are all
and
these
dad?
parents just buying them, giving them
And there's plenty
100
of
grand,
people
50
without
grand
Bank of Mum and
deposits.
Dad.
I mean, this is how it used to be. This is how it used to
there.
be. They are out there, definitely, but I don't think it's as common as it used to be.
I think they're not out there for a lot of people as well.
Yeah.
No, and I totally get that. But, you know, if you are looking to try and get on the housing ladder and you're in London and you're in a 34 times average income kind of thing, but we're talking average income as far as in the UK, right? We're not talking average income as in London. You know, in London, you might find that it's maybe, instead of being, you know, sort of 8 times the person's salary, London might be sort of 6 times that person's salary.
And I guess it's couples as well, isn't it? It's 8 times, it's 4.5 times a couple's income, which is probably 8 times one person's income. So
Yes.
you're probably getting less of a single person buying their own home, and then when they finally married, there's 2 houses and they might rent one out and so on. It's like the first purchase is the couple purchase.
Yeah, and we have got lenders that'll take 4 incomes into account, right? So you can
4
get
incomes.
Yeah.
Got the kids in the minds, mate. I
Yeah,
told you.
we've got, you know, like you get a group of friends together and they go and buy themselves a property, you know.
So they own the house share, basically.
Yeah, pretty much.
Yeah.
But you know, it's a way onto the ladder.
Yeah.
Let's get the boys together, Damo.
Yeah.
Rather than getting, you know, shared ownership and all these other things where, you know, you're getting involved with a big corporate, you know, you're doing it on your own back. Because the other thing that we've got, though, you know, I say Bank of Mom and Dad, is we've got this thing called joint borrower sole proprietor, all right, which helps a hell of a lot with people who mom and dad or the kids have got a deposit from an inheritance or savings or whatever it might be, but their income is not high enough to afford the house that they want to buy. We have got the option of adding either a partner, an unmarried partner, in where both of you are used for affordability. So you both have jobs, both your incomes go towards affordability, but only one person's name is on the title deed. And that's why you have to be an unmarried partner, because that works on that basis. But vast majority of this was devised so that mom or dad who have got an income can jump on that mortgage and help that kid afford the property that they want to buy, or, you know, because areas are quite expensive, they can afford that property that they want to buy while they're in their first year of you know, I mean, you could use a doctor or you could use a lawyer or an accountant or whatever it might be. An accountant starts off, he earns very little, but his trajectory is quite high. So that person can come in, do joint borrower sole proprietor, mom and dad help him afford it. Mom and dad are there as guarantors.
I was about to say it's a bit like a guarantor when you get
But
a
it
flat.
replaced the guarantor mortgage, because a guarantor mortgage doesn't exist anymore, because the lenders really found out the hard way that the paper that it was written on wasn't really worth it.
Where the guarantor's like, I'm not paying when it...
No, but I mean,
or-
they didn't really have a document behind it that was strong enough to actually enforce them to pay. Okay. So that's why we've had this change. So we've now got this joint borrower sole proprietor situation. It has pros and cons, because, you know, generally the older your parents are, that limits your term that you can have. And that's why a lot of the cases we end up still remortgaging mom and dad's house, giving the money to the kids by way of a gift,
I mean, we laugh about Bank of Mum and Dad, and there'll be people that have benefited from that. And I don't want them to feel ashamed about that, because I'll do that for my son. But I also want to acknowledge the fact that there's a lot of people that don't have that support, and that's why it's so difficult for them.
But those people can still get the same advice. They can still get the same help. They can still know what their options are. And, I'll be honest with you, I think a lot of people just assume that they can't do something.
What's the average age of a first buyer in the UK? If you know.
70 by
I
the sounds.
From the mortgages that we do personally, average first-time buyers are probably in their mid to late 30s.
Oh, I'm on time. Let's go.
And I think the average first-time buyer for us is probably in the mid 30s. And I think that's primarily because with housing stock being quite expensive overall, and incomes varying from region to region, it doesn't matter where you're buying in that region, you generally are needing to be at that age where you've had a bit of experience and a bit of career progression before you can actually jump in and afford it, and also have enough money to be able to build up that deposit. London property market has come off the boil a little bit, but there's still opportunity there. And I think houses in particular at the moment, because of the fact that so many landlords are sort of now thinking about selling up, are probably going to be your best appreciating asset. Flats maybe to a lesser degree, and that's number one, because a developer's going to come along and knock down 3 houses and put 18 flats on it. There'll be more and more flats in supply, whereas no developer is going to come and build more houses, especially not in sort of city centre kind of areas. So I think places where clients can afford to get onto a house rather than a flat, I'll definitely look at taking that jump rather than going down the flat route. But then, we've got some clients who are kind of going, right, I'm never going to have kids. I work like an absolute, mad person. And I'd much rather just stay 10 minutes away from work in a flat where I don't have to do any work. Those flats would obviously have a little bit more of a demand. But, your sort of standard new build kind of boxy kind of thing is going to be dime a dozen, and I think those properties will battle to appreciate in value as quickly as houses will in the next 10 years.
You've got any other predictions on the market?
Interest rates are going to hopefully get down to sort of 3.5%. I think it gets to 3.5%, that probably would be a point where, if I was that client I was talking about earlier where we're waiting for things to go down, I think 3.5% is a safe area for you to kind of go, actually, you know what, I'll get involved, because it's probably not going to get too much better. Because I think this 2% inflation rate is going to be a sticky one. We've been at 2.2 now for 2 months. It only takes a little change in fuel prices, a little change in world position to create problems with that sort of inflationary issue. And therefore, banks are going to have to continue to pay savers more to be able to put their money with them, which means that this 3.5% rate is probably going to be where we settle. But 3.5% is still a hell of a lot better than the 6 or 7 that we're at. I mean,
it's much more normal as well than 0, right?
Yeah, like if you look at it before we had the global financial crisis, the Bank of England base rate average was 5 to 5.5%. So, historically speaking, we're no different to where we used to be. It's just that we've been spoilt for a prolonged period of time with really, really cheap money.
Okay, there was a lot of information in that one. So what we've done is we've put together a summary of everything that we discussed in the episode, and you can access that using the link in the description.
And if you like this episode, you'll love the next one with Rob Dix.